Hey traders, Raghee here, and in this free recap video I want to talk about a move that I am anticipating in reaction to Jerome Powell's comments on Wednesday. Now, for those of you that are wondering, the kind of needle that Jerome Powell, the Fed chair, has to basically thread, it's a tough one. What he has to communicate is pretty darn important, and I was talking about what it is that could be very simply changed and communicate pretty much exactly what the market would like to see, which is this line right here. The committee expects that further gradual blah, blah, blah. When you look at each statement, for those of you that aren't already familiar with this, is the statements aren't original prose every time. There's a template and it's modified sometimes more, sometimes less with every single meeting, and it's these slight modifications that the market reads and pores over like a college student in a copy of Moby Dick for all the meaning, what are they trying to say? What's the symbolism, right? So I'm only slightly exaggerating, but that's the way this works. So I keep an eye on this Fed Statement Tracker, which is a free tool from Wall Street Journal. Big thanks to WSJ for this cool thing that makes it really easy for traders like myself to sort of hone in and figure out what the move may be. And I think this is going to take place in the second paragraph. The committee expects, etc. All right, so it's going to be that particular line and the FOMC, again, Fed Chairman Powell, basically saying that he will not even pick the color of his socks without it being data dependent. That data dependent messaging is going to be massively important as well, because that's what's going to let the market know that if we see weak inflation numbers and weak GDP, we can pretty much rule out rate hikes for 2019. How do we gauge that? With the CME Group's CME Fed Watch tool. So it's cmegroup.com, or just Google CME Fed Watch tool and it'll bring you this particular page. And if you want to juxtapose the 70-some% expectation, by the way, this actually dropped a little bit, but it's still in the 70s. It's still widely anticipated that we're going to see a 25 basis point or a quarter point hike, right? So we're going to see that quarter point hike, but then when you go out into the next meeting that has a press conference, now you start seeing a 50-50 shot that we stay at that level. And that really becomes kind of the theme as you go from each, and I'm going from March to June to September, because typically the Fed's only going to hike on those meetings that they have a press conference. So you start going out into September and all of a sudden you see we're pretty much 50-50 sort of pinned at this expectation that we're not going to see another hike. Right? So what is the market saying? Give us the hike and then message to us you're data dependent, and remove that line or modify that line in some way that tells us you're done. Okay? So you can gauge this. This isn't reading tea leaves. This is pretty concrete, pretty objective stuff. Right? This is the kind of research I like to do. This is macro, right? It doesn't get much more macro than the US dollar. Let's go there next. If the FOMC does signal that, my expectation is we're going to see a rally in things like the euro, or better put, a sell-off, a correction of the uptrend in the dollar. I do not believe, and please hear me out, because a lot of people think that once the FOMC stops hiking rates, that the dollar strength is over. Gang, it is not. We are in what I call the D phase of this economy, and historically in the D phase, I've seen this many times, ABCD for downturn. Okay, this is just the way I look at the market via three main touch points. Lots of Forex traders look at the market through these main three touch points: inflation, GDP, and central bank policy. Pretty easy broad strokes to track. Right? So one of them is coming up on Wednesday. We are in the D stage, meaning inflation is falling, growth is slowing, also falling, and now we're seeing a central bank that still is hawkish, which is about the worst phase of this sort of C to D transition, where you have slowing growth, falling inflation, and still a hawkish central bank. But that seems to be coming to an end, because as you mature as a D stage of the economy matures, what you start to see is a dovish central bank, and that gets us back into A eventually, right? It just goes all over again and again, okay? And it has a lot to do with the dollar cycle, debt cycle, and just how all that plays out with, again, central bank policy, inflation, and GDP. I do anticipate a move lower in the dollar because a lot of traders on the news that the FOMC may be done or done-ish will sell dollars off. As long as dollars stay above 95, I am going to continue to buy dollars against the euro, which means we might get a shot at another 115 entry. I would welcome that with open arms. Another 115 euro US short sell. Okay, that seems like a long way away. It's 150 pips, but it's very reasonable to be back up there. And that would be a trend following overbought short. I say trend, meaning the trend that I see overall in the next year to maybe more in the euro. So this is more of a trend or even a theme. I should say even it's more of a theme about what I think is going to be the Eurozone in 2019. And also I'll buy a pullback in the dollar versus Canada. So these are two charts that we're already in. We want to re-enter in, and the catalyst could be Jerome Powell. You know how and why and what I'm looking at and where this could land, dollar weakness, and we'll buy dollars into weakness against the euro and against the Canadian dollar. This could be played out in euro futures and in Canadian dollar futures, both of which would be shorts into corrections higher. Okay, I'm going to probably play this on the Forex side. Either way, pick your asset class, get long dollars on the weakness, and I'll see you in the next update.